Hi, welcome to our exam revision accounting tutorial on interpretation of accounts or ratios question as it's commonly referred to. Our learning intentions today are to be able to calculate all relevant ratios, to interpret these ratios, and to understand the theory behind ratio analysis. So first of all, we're going to look at the structure of the question. Interpretation of accounts is always question 5 on the Leaving Cert higher level examination paper. In part A, we're usually asked to calculate 5 ratios. In part B, we have to comment on these ratios from the point of view of either the shareholders, debenture holders, or banks. Debenture holders and banks are almost identical as they are both people who lend money to the company, and the shareholders is also answered quite similar, only though we may change one heading at the end. So usually we would do 5 or 6 of the same headings, and then the last heading will be different depending on whether it's shareholders or debenture holders or banks. And I'm going to go through the worked out solution to the 2018 question at the end, and we will talk about that more there. And part C then is usually a small theory part or another small bit of ratio analysis. So first of all, now we're going to look through all of our ratios that can be asked in part A. And again, some of these ratios will also be needed in part B of the question. So to start off with, we will look at our profitability ratios. The first ratio here that's commonly asked is return on capital employed. So to work out return on capital employed, and again, it's going to be a percentage, your answer. It's net profit before interest over capital employed multiplied by 100. There's an asterisk here beside net profit before interest because we need to check in the question is the net profit before or after interest. Usually net profit is after interest, so if that's the case, we have to add back the interest to get the net profit before interest. And this is nearly always the case. I think the one exception I can remember is in the 2012 paper when the net profit was actually after interest. So that's important, and again we'll see this net profit before interest in a lot of the ratios, so you always have to do that to check is the profit before or after interest, and usually it's after interest, so to get before interest you add back the interest. We're going to put that over capital employed, which is just the total figure of our balance sheet, and multiply by 100 to get our answer as a percentage. The second ratio here is return on shareholders' equity. So again, this is going to be net profit less interest, so not net profit before interest, net profit less interest, so net profit take away interest, and then take less preference dividend. And we're going to put that over our ordinary shareholders' equity, which is our ordinary shares and our profit and loss balance. With the preference dividend, we need to be careful with dividends because in the question we are always given total dividend, and we never use that total dividend figure for the ratios. We have to split that total dividend out between ordinary dividend and preference dividend. And again, I'll go to that in more detail in the worked out solution. But just quickly, how you do that is if there are 5% preference shares of 100,000, 5% of 100,000 would be 5,000. So the preference dividend would be 5,000. And let's say the total dividend was 40,000, then the difference, the 35,000, would be ordinary dividend. Liquidity ratios are very straightforward. A current ratio, working capital ratio, is we just compare our current assets to our current liabilities, and that should be over 2:1. And the more commonly used one, or the one that's perceived to be better, is the acid test or the quick ratio, as it's sometimes called. And again, that's just current assets, but this time we take away closing stock and compare that to current liabilities. Next, we're going to have a look at our activity ratios. So here, the first one is stock turnover, which is just our cost of sales divided by our average stock. And to work out average stock, we just get our opening stock and closing stock, add those together and divide by 2. That will give us average stock. The period of credit to debtors is just debtors over credit sales. And again, sales always go debtors, so it's debtors over credit sales. And if you want your answer in days, you multiply by 365 and in months by 12. Again, the period of credit received from creditors is a similar ratio, only though creditors will always go with purchases. So it's creditors over credit purchases. And again, if you want your answer in days, you multiply by 365, or months, you multiply by 12. Our gearing ratio. So gearing just sees how much debt there is in the company. So to work this out, we get our preference shares and our debentures. We add those and put them over capital employed, which is the total of the balance sheet, and multiply by 100. Preference shares are treated like loans from shareholders. They're kind of different than ordinary shares. So they're treated like a loan from shareholders. They're seen as debt, and debentures are long-term loans. They're also debt. So we put those over capital employed, multiply by 100. Interest cover, again, is net profit before interest, which we spoke about before, and then that's just over interest. And again, that will be in times, and gearing, your answer will be a percentage. Earnings per share. So again, earnings per share, now we're looking at our investment ratios. Earnings per share is net profit, less interest or take away interest and take away preference dividend over the number of ordinary shares. And again, we spoke about the less interest and the preference dividend in the previous slides. Price earnings ratio is the market price per share divided by the earnings per share. And again, with the price earnings ratio, the market price per share is usually given to you, but the earnings per share you will have to work out, and that's a separate ratio. So really, if you're asked the price earnings ratio, you will have to work out earnings per share before you can do it. So you effectively have to work out two ratios. The dividend per share is the ordinary dividend. So remember, we spoke about the preference dividend, being able to work that out, and we're given the total dividend. So the difference would be the ordinary dividend. So that ordinary dividend over the number of ordinary shares that were issued. Dividend cover, again, is just your net profit, less interest, so take away interest, take away preference dividend over your ordinary dividend. Or you can work out your dividend cover by getting your earnings per share and dividing that by your dividend per share. Dividend yield, again, is dividend per share, which we would have worked out in the previous slide here, dividend per share. So we worked that out there, over the market price per share multiplied by 100. So again, for dividend yield, you will effectively have to work out two ratios because you need to work out your dividend per share and then divide that by your market price per share multiplied by 100 to get your answer as a percentage. The period required to recoup its market value based on the present dividend payout rate. So if you're asked that, you get your market price per share and you divide by your dividend per share. So it's kind of the opposite of this one here. And again, your answer will be in years here, not a percentage. And the period required to recoup its market value, assume current performance is maintained. Sometimes they might say performance, sometimes they might say earnings. Either way, it's just your market price per share divided by your earnings per share. And again, another one that can be asked sometimes is your projected. So that's not projected. You will use next year's figures if they're given to you in the box. You won't be using this year's figures. So projected market value is just the price earnings ratio, your PE ratio, multiplied by your earnings per share, your EPS. And again, that's projected, so you'll be using the figures that you're given in the box in the question for next year. Sometimes you'll be given last year's figures to compare with, sometimes next year's. So that's all the ratios gone through that can be asked. Next, we're just going to have a look at a small bit of theory before we have a look through the fully worked out 2018 solution. So theory question that can come up a bit is, what are the limitations of ratio analysis? So ratio analysis is based on historical data only. These figures can become out of date very quickly, even by the time they're being used. They are of limited use in predicting future value. So they're historical, they look into the past. They don't look to the future. Ratios do not show seasonal fluctuations within an accounting period. So they might give you the totals for the year, but not like per season or per month or so on. Ratios do not take account of external factors such as the strength of the economy or the relative impact of global pandemic. So an example obviously would have been COVID. Figures requiring the share price for calculation can be impacted by the mood of the markets and the irrationality of public investors. Share prices change based on levels of optimism or panic in the market. Different firms use different accounting bases, making comparisons questionable. The comparison of one company to another may not be either accurate or meaningful. So an example of that would be where different companies might use depreciation, different percentages of depreciation, or different depreciation methods such as straight value or reducing balance and so on. Financial statements give a limited picture of a business. Many important aspects of a company are not revealed in the financial statements. These include stuff like the firm's market position, external changes within the market, and staff morale and management staff relationships, staff turnover. All that stuff will be very relevant to how a company is going, and that is not worked out in the ratio analysis. Liquidity and solvency. Sometimes you might be asked, what is the difference between liquidity and solvency? So liquidity measures the ability of the company to pay its short-term debts as they fall due. And as we spoke before, the asset test ratio is a good indicator of liquidity as it includes only liquid assets, cash and debtors. Okay, so that's better than the current ratio because you don't include stock, which may be hard to change into cash quickly in some circumstances. And in solvency, so liquidity is a short term, solvency is the ability of the company to pay its debts as they fall due for payment long term. So liquidity short term, solvency long term. Solvency is the most important indicator of a business's ability to survive in the long term. A business is solvent if its total assets exceed its outside liabilities. So debt to equity or total debt to total assets are good guides. So again, that's where the gearing ratio will come into effect. A question they ask sometimes also is a rising liquidity ratio is not always a sign of prudent management. So we were saying the asset test ratio should be over 1:1 and the current ratio should be over 2:1. But if these get really high, is that good? So a rising liquidity ratio could be a sign of prudent management because it indicates that it's easier for the firm's ability to pay short-term debts on time. So that's if it's over 1:1, they should be able to pay their short-term debts as they fall due, so for the asset test or quick ratio. And if they do that, then they'll avoid paying interest or they will avail of cash discounts. However, if the rising liquidity ratio is significantly above 1:1, it could mean that too much of the company's resources are tied up in liquid assets when they could be used to earn more profits. Management may be leaving cash resources idle. So if the asset test ratio is 4 or 5:1, that would probably mean that they have a lot of money tied up in debtors and cash, which could be invested or used better elsewhere. So now we're going to have a look at the fully worked out solution to the 2018 ratio question. Hi, today we are going to have a look at 2018 Leaving Cert higher level ratio question. As with all ratio or interpretation of accounts questions, this is question 5 on the paper. Again, in all of these questions, in part A, you are asked to calculate 5 ratios. So that's what we're going to do first of all. So the first ratio asks us to work out cash purchases if the period of credit received from creditors is 2.5 months. Well, I usually start off by saying that cash purchases, which is stuff you sell for cash straight away and get the money, plus credit purchases, which is things you sell on credit and get the money at a later date, or sorry, the things you buy on credit and pay for at a later date, they make up the total purchases. This question can be asked about sales similarly, and again we do the same thing, cash sales plus credit sales equals total sales. If the sales one is a bit easier, as total sales is given to us in the question, whereas total purchase is not. So we have to do a little work in here to find out total purchases. So total purchases is equal to cost of sales plus closing stock less opening stock. So if I go to the question, my cost of sales or cost of goods sold is 560,000. And I'm going to add my closing stock, which is 90, and take away my opening stock, which is 60. So I'm going to add 90 and take away 60. So total purchases is 560 plus 90 minus 60, which is 590,000. So now I know my total purchases are 590,000. From this information it gives us here, we can work out credit purchases because it tells us the period of credit received from creditors is 2.5 months. So we let the ratio for period of credit from creditors, we let that equal 2.5. And that ratio is creditors over credit purchases multiplied by 12, because my answer is in months, and that's equal to 2.5 months. So what I'd usually do here is I would say you cross multiply here. So I would say 12 times creditors multiplied by, and if you want to put the 2.5, you can put that over 1 if you like. So cross multiply, the top row here multiplies by the bottom row here, and similarly the top row here multiplies by the bottom row here. So 12 times creditors by 1 is just 12 times creditors, and that's equal to 2.5 times credit purchases. So that equals, and again, I'd usually start off by saying that I do this side first of all, because we're looking for credit purchase. So whatever I'm looking for, I keep on the left-hand side. So I would start off by saying 2.5 times credit purchases is equal to 12 times creditors by 1, which is 12 times creditors. So now we want to work out credit purchases. So I want to get rid of the 2.5 on top. So to do that, I divide by 2.5. And I divide by 2.5. That side of the equals, it will do the same thing here. These two cancel each other out, top and bottom. So I'm just left with credit purchases is equal to 12 times creditors divided by 2.5. Now from the question, if I go down to my balance sheet, I can see that creditors are 80,000. So it's 12 times creditors, which are 80,000, divided by 2.5, and 12 multiplied by 80,000, and I'm going to divide that by 2.5, is 384,000. So now credit purchases are 384,000. So my cash purchases must be the difference, because my total purchases are 590,000. My credit purchases are 384, so my cash purchases are the difference, which are 206,000, and that's what we were asked to calculate. The second ratio we were asked to work out, excuse me, is the dividend yield. So the formula for dividend yield is dividend per share divided by market price per share multiplied by 100. Now, the market price per share is easy. It's usually given to you in the question underneath the balance sheet here. The market price or market value of a share is €1.35. Now, when I'm working with these, I would usually put them in cent, because earnings per share and dividend per share are usually in cents, so I put them all in cent. So market price per share is 135 cents. Now I need to get the dividend per share. Now, unfortunately, to get dividend per share, we need to do another ratio, because the formula for dividend per share is ordinary dividend over number of ordinary shares. Now, at this stage, I would usually divide out my dividends. Sometimes I do it at the very start. You can do it at the start of the question, or you can just do it when you need to here. So to divide out the dividends, because sometimes for the ratios you need ordinary dividend and sometimes you need preference dividend. So in the question, we are always given total dividend or dividend paid up here in the profit and loss. So dividend paid in this question is 45,000. So that's my total dividend. And we have to separate that out between preference and ordinary, because the preference and the ordinary make up the total. So we're given total dividend in the P&L. From the information we're given at the bottom of the balance sheet, we can work out the preference dividend, because there are 8% preference shares, 200,000. So 200,000 shares, and they get a dividend of 8%. So the preference dividend is 200,000 by 8%, which comes to 16,000, and the difference has to be the ordinary dividend, which is 29,000, because they must add up to the 45. So back to our ratio here, dividend yield. Now it's ordinary dividend, which we're after working out there. So I'm just going to go back down and get my ordinary dividend, which is 29,000, over the number of ordinary shares. So the number of ordinary shares I get from my balance sheet. How many ordinary shares are there? There are 350,000 ordinary shares. So again, I'm going to divide those, and that comes to 0.0829, and that's in euros, because these figures are in euros, so that's in euros. So to get it into cent, I'm just going to move the decimal over 2 places, so it's going to be 8.29 cent. Okay, so now I know my dividend per share is 8.29. So to work out my dividend yield, I'm just going to get my dividend per share, which is 8.29, divided by my market price per share, which is 135, and to get it as a percentage, I'm going to multiply it by 100. So that works out to be 6.14%. Now with all of these, you usually would round off to 2 decimal places. The third ratio we're asked to work out here is the price-earnings ratio. So the price-earnings ratio is market price per share over earnings per share. So again, market price per share is easy. We've done it already. We're given it at the bottom of the balance sheet, or just underneath the balance sheet. It told us it's €1.35, which is 135 cents. And I'm going to divide that by earnings per share. Now again, earnings per share is another ratio. So the ratio is net profit less interest less preference dividend over number of ordinary shares. The reason I have less interest in green is that nearly always, the net profit nearly always is less interest, but not all of the time. I think the last time it was asked differently was in 2012, and in some mock papers it is. So I just left the formula like this. So if we go back to the question, and what do I mean by that? If we go back to the question, my net profit of 82,000, that already is less interest. The interest has been taken away, so I don't need to do anything there. So net profit less interest is 82,000. So I just need to take away my preference dividend. So again, my preference dividend, I've split my dividends down below here. My preference dividend is 16,000. So it's going to be 82 minus 16 over the number of ordinary shares, which again we looked at already. The number of ordinary shares are 350,000. So to work this out, it's going to be 82 minus 16 divided by 350. So again, that's €0.1886. And to get it in cent, I'm going to move the decimal over 2 places, 18.86 cents. So now I have my earnings per share. I can fit it in here. It is 18.86. And to get my price earnings ratio, market price per share divided by earnings per share, and it is 7.16. So some people say 7.16 years, and some people just say 7.16 is to 1. Either way is fine. The next ratio we have to work out is return on capital employed. So ratio number 4 we're asked to work out is return on capital employed. So the formula for this is net profit before interest over capital employed multiplied by 100. So in the question, my net profit of 82,000 is after the interest has been taken away. So to work out my net profit before interest, it is 82 plus 18. I add back my interest. Okay, so it's 82, because that's my profit after interest. So before interest would be 82 plus 18 over capital employed, which is just the very last totaling figure in your balance sheet. So capital employed here is 930,000. I'm going to multiply that by 100 to get it as a percentage. So it's going to be 82 plus 18 divided by 930,000. So that works out to be 10.75%. And the last ratio we have to work out is interest cover, which again is an easy enough ratio. It's just net profit before interest over interest. So similar to the previous part here, the net profit after interest is 82,000. So before interest will be 82,000 plus the interest of 18, and again divide that by the interest of 18. So that's going to be 82 plus 18 divided by 18. And that works out to be 5.56 times. So now that is part A of the question complete. Part B of the question, usually in part B of the question, you were asked to comment on it kind of from the point of view of debenture holders or banks, which are pretty much the same thing. Debenture holders are just people who give long-term loans also. So they're treated as kind of similar. To answer those questions the same, debenture holders and banks. Or the other point of view you can be asked from is shareholders. So here we are asked, indicate whether debenture holders will be satisfied with the performance, state of affairs and prospects of the company, and use relevant ratios and other information to support your answer. So with this part of the question here, I would always try and structure the same way, because if you look at lots of solutions from examinations.ie, like every year they're answered differently and it can be very hard to kind of figure out what's going on. So with these, I would use a kind of standard template to answer these questions. So my first heading would always be profitability. Okay, so the profitability, the ratio you would use for profitability is return on capital employed. Now, we have this done in part A, so obviously if you had it done in part A, you wouldn't have to do it again, but I'm just going to do it here because in some questions you won't have it done in part A. So I'm just going to do it again quickly. It's net profit before interest, and as we said in the question, this net profit of 82,000 is after interest of 18. So the net profit before interest would be, and again, see, we have it done here, it's 82 plus 18 over capital employed, which again, just to quickly look at it, we said was the total of the balance sheet, 930,000. So that is going to be equals 82 plus 18 divided by 930,000, 10.75%. So now we have to comment on this. And again, there's no like set answer for this because the return is kind of different for everybody. You know, some people might be happy with a return of 7.5%. Some people might be happy with a lower return. Some people might be looking for a higher return. But so the general rule is that in around 10% would be seen as a good return. Now, again, I have questions that I use here to help guide my answers. So I'm just going to kind of try and answer these questions here. But first of all, the company is profitable. Okay, it's 10.75%. If it's making over 7, 8, 9%, I suppose the company is profitable. However, and again, there's three things I would always compare it to. Compare it to the previous year, compare it to the rate of return on risk-free investments, banks, building society and credit unions, and compare it to the rate of borrowing on debentures. And we'll talk about those three things in a minute. So first of all, we see what the return on capital employed was last year. So last year, the return of 12.4%, which is higher. So the company is profitable. However, the return on capital employed has disimproved. So it's gone down from 12.4% in 2016 to 10.75% this year, which is a negative trend. Okay, if it's gone up from last year, you would just change that to improved and positive trend. The company has made less efficient use of resources than the previous year because it has gone down. If it had went up from the previous year, you would simply say the company has made more efficient use of resources than the previous year. Again, even though it's gone down from last year, it's still a fairly good return. Now, the return of 10.75% is still well above the rate of return on risk-free investments of 1 to 2%. So if you have your money and you invest in a bank, building society or credit union, something like that, you'll get a return of somewhere in between 1 to 2% probably at the moment. They're getting a return of 10.75% for investing money in a company, so it's a lot better. We also compare it to the cost of borrowing on debentures, because there's no point borrowing money and paying a certain percentage on that and then earning a return less than that. So this company is borrowing money and they're paying 6% interest on it. So we compare our return to that, and 10.75 is better than 6. So it probably doesn't make sense to borrow the money in this case. So we simply say it's also above the company's cost of borrowing of 6%. If the company's cost of borrowing was 12%, you'd say it was below the company's cost of borrowing of 12%, which would be a worrying trend or something like that. Because the company is profitable, we can just say here at the end, the company should have no problem paying interest to debenture holders. If we were talking from the point of view of shareholders, we simply change that the company should have no problem paying dividends to shareholders. So that's the first heading we'd always look at, is profitability. The second heading we always look at would be the liquidity ratio. Okay, so for liquidity heading. So for liquidity, we usually use the asset test or quick ratio. So this is simply current assets minus closing stock, and we compare that to current liabilities. Some people would use the current ratio here also. The current ratio is just current assets is the current liabilities without the closing stock. But taking away the closing stock is seen as a more accurate measurement of liquidity. So in the question, current assets are 160,000 and closing stock is 90,000. So here I'm going to have 160,000 minus 90,000, and we're going to compare that to current liabilities, which are liabilities less than 1 year. So liabilities less than 1 year are 80,000. So 160 minus 90 is 70,000, and we're comparing that to 80,000. So 70 divided by 80 is 0.88 is to 1. Okay, so this ratio really should be over 1 is to 1. If you're using your current ratio, it should be over 2 is to 1. So to answer this, the acid test ratio, and again, we'll just have a look at what it was last year to comment on it. So last year, the acid test or quick ratio was 1.3 is to 1, which is good. It was okay. It was over 1 is to 1. Now it's gone to 0.88 to 1. So the acid test ratio has disimproved from 1.3 to 1 in 2016 to 0.88 is to 1 in 2017. This is a negative trend and will worry the venture holders. If it's under 1 is to 1, it's always very worrying. The company has a liquidity problem. Again, if it was over 1 is to 1, you would say there's a positive trend and it wouldn't worry the venture holders. And if it was over 1 is to 1, you would say the company does not have a liquidity problem. This company has a liquidity problem because it's less than 1 is to 1. And you can say that this may be due to over trading. We're not sure if it is or not, but it's a good point to put in. I suppose that just really means that they're making lots of sales, but they're not getting in all the money in time. Again, this is another standard sentence. The company has 0.8, that should be 0.88. The company has 0.88 euro or 88 cent available in liquid assets for every €1 owed in the short term. So for every €1 they owe in the short term, they have 88 cent. If this was 1.5 is to 1, they would have €1.50 for every euro they owe, which would be good. The company will have difficulty paying debts as they fall due. Okay, because it's less than 1 is to 1. If it was over 1 is to 1, you would say the company would not have difficulty paying short-term debts as they fall due. And the company may have a problem paying interest to the venture holders. So we're looking from the point of view of the venture holders. This company doesn't really have enough money in the short term to survive, so they're going to struggle to pay back the interest and eventually the loan to the venture holders. The next heading we look at is gearing. Okay. So under gearing, there's two ratios we are going to look at, the gearing ratio and interest cover. So just before we work out the gearing ratio, the bottom of the balance sheet here is made up of 4 figures, 300,000, 350, 280. Of these 4 figures, 2 are seen as debt and 2 are seen as equity. The debentures are debt, they are long-term loans. Ordinary shares are equity, they're shares that were bought in the company. Preference shares are debt because they are treated differently than ordinary shares. They're seen more like a loan from shareholders, so they're seen as debt. And profit and loss balance coming forward, that's profits coming forward, so that is equity. So what we're seeing is out of the total of the balance sheet, how much is debt? So really what we're doing is we're adding our 300 and our 200, which are the debt figures, and we're putting that over the total of the balance sheet, 930. And again, if you can't remember which ones are debt, they're the ones with the percentages on them, but you're taking the full figures, the 300 and the 200. So the debentures we said were 300,000, preference shares 200,000, and we're putting that over capital employed, which is the total of the balance sheet, 930,000. And we're going to multiply that by 100 to get as a percentage. So it's going to equal 300 plus 200 divided by 930. So that comes to 53.76%. And again, interest cover, we actually have this done in part A. So again, if you are in the exam, you wouldn't have to do it again, but we won't always have it done in part A. For sake of the video, I'm going to do it again. So it's just going to be 82. That's the profit after interest. So before interest is 82 plus 18 over 18. So 82 plus 18 over 18. So let's try that again. So it's 82 plus 18 divided by 18. And I'm not sure why that's not coming out properly, but we'll just take it from the previous time, which is 5.56%. This is just too many decimals is the problem. Okay, 5.56%. Right. Okay, so we have to comment on this now, right? If a company is over 50%, it is highly geared. If it's under 50%, it's lowly geared. And if it's exactly 50%, it's usually gearing. So this company is highly geared. Now, what was the gearing situation last year? Last year, it was 41%. So it was lowly geared last year, highly geared this time. So highly geared is obviously worse because more of the firm is run by outside people, it's owned by outside people, and there's more debt in the company. So the company is highly geared. Last year, it was lowly geared. The gearing position has disimproved because it's gone higher. It's gone from low to high. So it's disimproved from 41% last year to 53.76% this year. The company is more at risk from outside investors because it's gone up. If it was gone down, you would say the company is less at risk from outside investors. The business will be financed on a long-term basis more by debt than by equity. If it was less than 50%, it will be financed on a long-term basis more by equity than by debt. Just change it around. The interest cover, so again, last year, interest cover. And again, the higher the interest cover, the better, because the more times profit they have than interest they have to pay. So interest cover was 6.3 last year. This time it's 5.56, so it's gone down slightly. So it's gone down slightly, which is bad. It was over 6 last year. It's just gone down to 5 now. So the interest cover has disimproved from 6.3 times in 2016 to 5.56 times in 2017. These negative trends will worry the debenture holders. So the debenture holders won't be happy that it's gone from lowly geared to highly geared and the interest cover has disimproved. And again, if it was from the point of view of shareholders, these things will also not please shareholders. Dividend policy. So again, dividend policy can be something that students find difficult to comment on. So before I even start commenting, I usually just do out this little table, which makes it a lot easier. It looks like a lot of work, but you actually usually have most of this information got already. So it's just a matter of getting it from the question, from part A of the question, or usually from the question in a paper, and putting in these figures. So EPS and DPS were usually given. So earnings per share last year was 20 and dividend per share was 10. So earnings per share is 20, dividend per share is 10. So to work out the payout, how much of the earnings to pay out in dividends, it's simply the dividend per share over the earnings per share. And I'm going to multiply that by 100. So 50%, they're paying out exactly 50% of their earnings through dividends to shareholders. The dividend cover is earnings per share divided by dividends per share. Sometimes you're given the dividend cover, sometimes you're not. And again, in this question, it says 1.3. And again, I think there was a mistake in this question as far as I remember. They said it accept either 1.3 or 2. They should be the same, those figures. So I think there was just a little mistake in that. So we're going to go with 2, okay? And the dividend yield is the dividend per share, which is 10, divided by the market price per share. Now I'm just going to fill in the market price per share. So last year, the market price per share was €1.60. So €1.60. So the dividend yield is the dividend per share, which is 10, divided by the market price per share, which is 160. And to get it as a percentage, we're going to multiply it by 100. So that works out to be 6.25%. Now we're going to do the same figures again for this year. Usually you have these worked out in part A. If you don't, you'll have to work them out, but 90% of the time you already have these worked out. So if I go back to part A of the question, and my earnings per share, I have it worked out here, is 18.86. My dividend per share, again, if I go back here, my dividend per share is 8.29. So you can see that this table isn't as hard to do out as you would think. My payout is that earnings per share divided by this, dividend per share divided by earnings per share. and I'm going to multiply it by 100. So they're paying out 43, nearly 44% this year. Dividend cover is earnings per share divided by dividend per share. And dividend yield, and again, I think we have this worked out in part A, but it should be dividend per share. And again, I'm just going to, before I do that, I'm just going to put in my market price per share. So the market price per share is €1.35. So it should be, so €1.35, so 135 cents. The dividend yield is dividend per share divided by the market price per share and multiply by 100. So 6.14%. And again, that's the same ratio as we worked that out in part A, and again, that was 6.14% dividend yield. Okay, so we're going to comment on these ratios. Now, dividend policy is probably slightly more important for shareholders. They'd be more concerned about dividend, but it's also important for debenture holders or banks because they want to make sure that the company is not paying out too much dividends to shareholders and that they're keeping some of the money to reinvest in the company. Because if you look at, I suppose, any company, this company here, they have a net profit of 82,000. So there's two things they can do with that, really. They can pay out some of the money to shareholders. So this company has paid out 45,000 in dividend to shareholders, and they're keeping the remainder 37,000. So that's kind of what we're looking at here. They usually say in around 50% is good. So you give 50% to the shareholders to keep them happy, and you keep 50% to reinvest in the company. Okay. From the point of view of the bank, they definitely don't want it higher than 50% because then they would feel that the company is paying too much money to their shareholders and they're not planning for the long term, as in to pay back the interest and the loans to the venture holders. Again, if you're looking from the point of view of shareholders, you might think they would like a really high return, but they would probably be happy with around 50% because they're getting a return and they're also kind of keeping an eye on the long-term stability of the company. If they're getting a payout of 80%, it'll be good for a year or two, but it won't be good in the long term. So around 50% is good. So the earnings per share, both earnings per share and dividend per share have dropped from the previous year. So they're broken down slightly from the previous year. In 2016, the company paid out 50% of the profits in dividends, and this reduced to 43.96 in 2017. The venture holders to be happy enough that the company are not paying out too much dividends to shareholders, and they are keeping some of the profits to reinvest. So again, if this was up at 60, 70, 80%, the venture holders would not be happy. The dividend cover has increased from 2 times to 2.28 times, which is a positive trend. So it's gone up slightly. Same as the interest cover, the higher the better. And the dividend yield has dropped slightly from 6.25% to 6.14% in 2017. But again, that's greater than the return you get from risk-free investments of 1 or 2%. So that is our fourth heading looked at, which is the dividend policy. So again, if you draw out the table, first of all, then it's just a matter of commenting on these figures. Sector. So sector, there's no ratios as such to work out here. We just have to comment about the sector that the company's in. So again, this will probably change on a yearly basis depending on the economy and all that kind of stuff. So you just have to make some valid points in relation to the company. And usually you will have a look at in a short-term view and a long-term view. So this company here, Born to Run PLC, they're a retailer in the sportswear industry. Okay, so the comment on that, and again, this was back in 2017, okay, so it would have changed slightly at the moment. But they are a retailer in the sportswear industry. So in the short term, it's a good industry to be in as a growing industry, and people are becoming more health conscious. Okay, however, long-term prospects would not be good as it's hard to compete with large organizations like Sports Direct and Nike and all of these companies, it's very hard to compete with online retailers in the sports industry too. They can obviously charge a lot less prices than Born to Run would be able to. So it's hard to compete with online retailers who can sell at a fraction of the cost, and the sector may be under pressure from competition from abroad. So again, like an Irish company here, like Born to Run, they might find it hard to compete with your likes of your Nike and Adidas and so on. The last heading. So again, as I said, when I'm doing part B, my first 5 headings will always be the same. I'd always use the first 5 headings. And if I'm talking from the point of view of banks or debenture holders, my 6th heading will be security. And if I'm talking from the point of view of shareholders, my last heading will be always share price. Okay. So security, what are we trying to do here? So basically in the question, we're looking at from the point of view of the debenture holders. So the debenture holders have given a loan to this company. They've given a loan of 300,000. So it's now 2017 in the balance sheet. This has to be paid back in 2024. The loan has to be paid back and the interest has to be paid back each year also. So what we want to see is the company getting ready to do that. So first of all, we're going to look at the assets of the company. So again, from the balance sheet, fixed assets are 650 and investments are 200. So fixed assets 650 and the investments are 200,000, which makes up the total fixed assets of 850. And how much are our debentures? Our debentures are, as we said, 300,000. So basically what we're looking at is if the company cannot pay back the loan, do they have enough assets that the debenture holders can take instead of the loan, which it looks like they have here at the moment. So the total value, again, is because if the debenture holders are 300,000 and they had only 100,000 assets, then if they defaulted on the loan, there wouldn't be enough assets there to cover the loan. So the total value of fixed assets at cost is 850. So this is 850,000. Now sometimes we are told we are given a breakdown of tangible and intangible fixed assets, but here we're not. We're just told that there's 650. We're not given the breakdown here in the question. We're just told fixed assets. So we don't know, I suppose, what's fixed and what's intangible. So tangible/intangible fixed assets are 650, which appears more than adequate to cover the debenture of 300,000. You would have to question how much of the total fixed assets are intangible assets, okay? Because the tangible assets are obviously better. They're easier to change into cash if it needs be. The debenture holders would question what the depreciation policy of the company is. So again, that's a sentence we'll always put in. It doesn't say what rates of depreciation there are. We're not given that information, so it would be a good thing to know. So we just note that point always. Then we have a look, and if we were told the intangible assets, you would question what the true value of intangible fixed assets are. Because stuff like patents and goodwill, they've been written off over a few years, so we kind of need to know what the real value of those intangible fixed assets are. The investments, so the market, but these investments cost 200,000. The market value is 150, so they're gone down by 50 grand. They paid 200,000 for them at the moment, only worth 150. So we need to comment on that. The 200,000 investments have a market value of 150, indicating a poor investment policy by the company. So the debenture holders would also question the true value of intangible assets. And that's what I was saying earlier on. We don't know anything about those intangible assets, so it's just a sentence we put in. So there does seem to be adequate security for the loan. And another sentence you could put in also is the tangible fixed assets, they're always secured, the debentures are always secured on the tangible fixed assets of the company. Okay, so that is part 6 done. So now I just write some sort of a conclusion, okay? So the conclusion I would come up with is the debenture holders will not be satisfied with the performance state of affairs and prospects of the company, because that's what we were asked, as its profitability has decreased and the company has a liquidity problem. The company has also gone from lowly geared to highly geared, which would worry the debenture holder. So again, if they're having a liquidity issue, it's a big no-no. And that, along with the drop in profitability and going from lowly geared to highly geared, would worry the debenture holders. Now, sometimes when we get asked this question here with the performance state of affairs and prospects of the company, people would put profitability and dividend under performance. They might put liquidity, gearing and investment policy under state of affairs, and security and sector under prospects. Okay, now the investment we've actually put in with the security. So again, I just always do them in the exact same order because I think it's easier for students to see how it works when you always do it the same way. But if you got really good at them and you're confident at them, then you could just change the order if you wanted and put them in this order: profitability and dividend under performance heading, and so on. So that is part B of the question completed. Part C of the question. So sometimes part C is a little bit of theory. Sometimes it's kind of more working on figures or ratios. So here it says, Born to Run PLC is considering expansion by purchasing a small sportswear company. It has obtained the following information relating to that company. So the period of credit allowed to debtors. So this is the amount of days that they allow people that to sell stuff to pay them. So it goes from 60 to 40, which is good. It's gone down. The period of credit received from creditors. So this is the amount of, when you purchase something, how much time are people allowing you to pay it back. So that's gone from 20 to 34. It's gone, which is good also. And the stock turnover, how quickly the stock is turning over, has gone from 12 to 6, which isn't good. So we need to comment on this. What advice would you give to Born to Run PLC about purchasing this small sportswear company? So part C, the length of time it takes a debtor to settle their account has improved by 20 days. So from the first year, it was taking them 60 days to pay, now 40. This is a good trend. The liquidity position of the business is improving as it is collecting debts more efficiently or quickly. However, while the liquidity position has improved, the collection period from debtors is longer than the average period of credit of 34 days received from creditors. So it's taken people 40 days to pay them, but they have to pay people back in 34 days, which isn't good. Because you can see here the period of credit received from creditors. So length of time a business has to settle accounts with suppliers, it's improved. It has improved. It's gone from 20 days to 34 days. We have to pay them maybe 34 days now. This is improving liquidity position and is taking longer to settle accounts with suppliers. However, the business may lose out on discounts for prompt payment, which may have a negative effect on liquidity. So yeah, we're getting more time to pay the creditors, but again, we might be missing out on some discounts because if you pay quickly, sometimes you get discounts. But again, this is kind of the key thing here. It's taken people 40 days to pay us, but we have to pay people in 34 days, which isn't good. Okay, because we're going to be paying the money back quicker than we're getting it in. And stock turnover has worsened. It's fallen from 12 times to 6 times. This is a negative trend. The liquidity position of the business has worsened as it's taken much longer to sell stock. So the stock's not turning over as quickly or selling as quickly, it's taking longer. This may mean it may have too much money tied up in stock, which isn't good. It could be used elsewhere for different things, for better purposes, when it could have been used for other purposes. If the decrease in stock turnover is as a result of decreasing sales, this will also have a negative effect on liquidity as it'll have less revenue. So if the company is selling less, it's obviously going to lead to liquidity problems because they won't have enough sales and cash, which wouldn't be good for the company. So we would not recommend Born to Run PLC to invest in this business. That's 2018 ratio, a higher level question 5 complete. Thank you.